the first one is on Pop and Fuss Family Inn, and it asks us to calculate the budgeted overhead cost for a month if the activity level is 76 guests. Okay, so what they give us is the activity level. The variable cost. And the fixed costs. Okay, and they want us to get the rate for 76. Okay, well here the cost is $86. Here the cost is $507.40. Utilities is $340. Okay, so the first thing you want to do is look at your variable expenses, your supplies, and your laundry. And you want to get your rate, your activity level rate. So it is the $86. I'm sorry. You're doing the cost over the activity level. So in this case, it is the $86 divided by the 86 guests, and that's $1 per guest. And the laundry, same way, is going to be $507.40 over the 86 guests, and that gives us $5.90 per guest. Okay, you take $1 per guest and multiply it by 76. Same with the $5.90. Okay. And those are our variable costs, and those are the ones that change. So here, this is going to be $76. Here, the laundry is going to be $448.40. Our fixed expenses, they're not going to change. They just remain fixed. $340, $47.90, and then $26.20. You add those up, and that'll give you your total costs. $6, $9, $16. $82.74.40. Are there any questions on that? Okay. All you're doing is looking at the activity level, calculating the rate for the variable cost, and then reapplying that for the new activity level. The fixed costs will carry over at the same amount. Okay. Yeah, you can zoom in some. Okay, so question 2 is about Buonocore Clinic. Joey, do we have question 1? Does everybody have question 1 written down? Yes? Yes? Alright. Alright. Question 2 is Buonocore Clinic uses client visits as its measure of activity. During August, it had budgeted 2,800 client visits, but its actual level of activity was 2,770. They want to calculate the activity variance, the revenue variance, and the spending variance. Okay. So first thing we are looking at is the personnel expenses, right? For the activity variance. And activity variance is the difference between your flexible and your planning. Okay? So if we look at the personnel expenses for the flexible, for the flexible. Personnel expenses would be what? The fixed element, 31,800 plus 1,560 times what? Times 2,770. There we go. Whereas the planning would be 31,800 plus 1,560 times what? 2,800. Everybody know where you got that number from? Okay, to 2,800, the planning. This is the budgeted amount. Okay, whereas that 2,770 is the actual number of guests. Okay, and then you'll just do that math. 31,800 plus 15,600 times 2,770. Okay, and this one will turn out to be Is this favorable or unfavorable? Favorable. Why? Because your flexible was less than your planning. Okay? Any questions on calculating that? Okay. Revenue variance. Okay. A revenue variance is the difference between your actual revenue and the flexible budget. Okay? So your revenue variance is the difference between your actual and your flexible. Okay? What was our actual revenue?
132, 124.
Okay, they gave it to us this time. We don't have to do any math. It is just 132, 124. Let me move that even over a little bit. Okay? And then to calculate your flexible, you get your revenue per client, $46.20 times 2,770, the number of actual client visits. And 4620 times 2,770 is 127,974. Okay? That is a variance of 4,150. Okay? And this one is, it's what? You'd rather have less money? This is revenue. This is the one case where if your actual comes out to be greater, it's favorable, your revenue. All right.
Are you the 4620?
46.20, got it right off the paper. $46.20 per client visit. That's how much we get in revenue, multiplied by the actual number of visits. All right. And then lastly, calculate the spending variance for medical supplies. Spending, just like the revenue, is a difference between your actual and your flexible. Okay? The flexible for our medical supplies says we should be paying $1,800 and then $6.10 per client visit. So this should be $1,800 plus $6.10 times 2770, the actual number of clients visited. Okay? And we're going to compare that with our actual medical supply spending of how much? $18,697. So how much is my variance? They're what? They're the same, so my variance is 0. Okay, these amounts are the same, so that means my variance is 0. No variance. Okay? Any questions on these first 3 questions about variance? Okay? Alright, we're going for next, which is the Variance Company or Corporation. Everybody have what's written on the board? Alright. Any questions on these?
So, say the flexible came out to 1900, it would be favorable since you spent less.
If this were 19,000, yeah, that would be favorable. Okay. All right. Number 3, A, Variance Corporation makes the products with the following standard costs and a whole lot of information. And the first thing they want us to calculate is what? Materials, price variance. Okay? Material price variance is the difference in the actual in the price. The price that you thought it was and the price that it actually turned out to be. Okay? Now they have it shown 2 ways, price variance, right? It's either AQ times AP minus AQ times SP, or it's the AQ times AP minus SP. Right? Okay? In this case, we're using this one. How do you know which one to use? Good question. Well, do you see the actual price given to you anywhere? The actual price, the price per unit, how much it costs me per pound, per whatever, per...
Standard rate up top right.
What is what?
$72 per pound.
Is that a standard price or is that an actual price? Okay. So what happens is generally you're given this as a total. This is given to you as a total. Already. So what does it say? Raw materials used in production, purchases of raw materials, 85,000 pounds. Actual cost of raw material purchases, 240,000. Actual cost of raw material purchase. My actual quantity times my actual price is the cost. True? Okay? So what happens in this case is we get that one already given to us. And then it also tells us the amount that we bought. Did it tell us our quantity of purchase? Does it tell us the amount that we purchased? 85,900. So now we have everything that we need. So we have the total right here, 240, 520 minus my actual quantity they told us is 85,900 times my standard price for direct materials is $3 per pound. So it's everything that can be filled in. Okay? So this is 240, 520 minus 257, 700, and this side then becomes 17,180. Okay? Favorable or unfavorable? So we would actually call this a negative. So this would be
Favorable.
right. The actual price that I paid is less than what I thought I should be paying. So this is favorable. All right. Next thing. Calculate the materials quantity variance for April. Okay? Okay, one thing you want to make sure you remember, the difference between the price variance and the quantity variance. The price variance is just how many you purchased. The quantity variance is dependent upon how much you used in production. So it's just based on how many you should have used in production. So the quantity variance is okay? Actual quantity times your standard price minus your standard quantity times your standard price. Yeah. This right here, these standard quantities, are the amounts we have to come up with a calculation for. Okay? Our standard quantity is our SQ is Okay? SQ is our standard quantity for a given output. All right? So our output is, actual output is 8,800 units. Okay? So we say 8,800 units times, how much should I use per unit? How many pounds of material should I use per unit? 9.2. Does everybody see where we get that? Okay? There's your direct materials, standard quantity. We made 8,800 units. We should use 9.2 pounds per unit. So that means we should be using how many pounds in this production? Is that 9.2? Okay, 8,800 times 9.2 is 80,960. Okay? So they tell us, and remember this is either or. Either one of these will work. I'm going to use this one. Standard price is what's our standard price per pound of material? $3. Okay? That gives it to us directly. All right? We've got a standard quantity. Now all we need is the actual quantity. Actual quantity, okay, is what? Is how much? No, actual quantity used in production. How many direct materials did we use in production? Who?
9.2 times 8,800.
That's a standard that we came up with. We came up with, we're making 8,800 and our standard is 9.2 each. This is our standard quantity. The question is, what is the actual quantity that we used? Excuse me? 78,150. Raw materials used in production. Okay? We're using the numbers for production as opposed to the ones for purchases. So the actual quantity we used, 78,150. So now this is standard price, $3 times the difference between 78,150 and 80,960. Okay? I don't know what that is. Okay, is this favorable or unfavorable? There's negative again, so it's going to be favorable. Yes. Okay. Any questions right now? All right, so make sure with the materials quantity variance, you get that standard quantity allowed by multiplying the number of units times the standard per unit. Okay? We are going to see that again with the labor efficiency variance. All right? There's 3A, that's 3B, here is 3C. Okay? 3C, calculate the labor rate variance for April. Okay? Labor rate variance, actual hours times actual rate minus actual hours times standard rate. Okay? So here they're going to give you the actual hours and the actual rate already. It should tell you actual direct labor cost is that right there. Okay? $39,424, right? And then they tell you the actual direct labor hours, 2560. And then the standard rate is what? 17 $17 per hour. Okay, it's just the standard that they give you. So this now becomes 39,424 minus 2560 times 17. Okay. $4,096, that's also negative, so that will also be favorable. Okay. All right, now we're doing the labor efficiency. Okay. Okay. We already know the standard rate. We already know the actual hours. Actual hours is 2560. Standard rate is $17. Now we need to figure out what these standard hours are. And this is what? Standard hours for given output. Okay? What is our given output? 8,800 units. 8,800 units times how many hours should we use per unit? 0.3. Okay, and that will give us our standard hours. 2640. Okay, so now we have this. This can also be written as standard rate times actual hours minus standard hours. 17 times 2560 minus 2640. Okay. And this is negative. Something like that. Is how much? 17 times 8. $1,360. Favorable or unfavorable? Okay. It's negative. Favorable. Negative just means it's favorable. Where did I get to 2560? Actual direct labor hours. Actual.
Yeah, makes sense.
Mm-hmm. Any other questions? Okay. Now we gotta do these journal entries. Everybody have this written down? Yes or no? No? Okay. All right, everybody else got it written down? Okay. Now we're going on to 3E. All right. 3E, prepare journal entries for the purchase of raw materials and the raw material price variance, use of raw materials, application of direct labor, and the labor rate efficiency variances. So it's just taking all these variances and journalizing them. So 3E. So first we're going to go for, what is it, raw material price variance, all right? All right. When we record the raw materials inventory, it is going to be recorded for the actual materials at the standard cost. Okay? Another way to say that? AQ, I'm sorry. It's going to be AQ times standard price. The accounts payable is going to be your actual quantity at your actual price. Okay? And the material price variance, if it's favorable, it's going to be credited. Okay. So you're recording your raw materials inventory at the actual quantity times your standard price. So 85.9 times the $3. The accounts payable is the actual cost that you recorded, the $240,520. The variance, the material price variance, is the difference between those two. Okay? Now we're going to do the material quantity variance. Okay? The works in process is going to be debited for the standards. So the standard quantity times the standard price. Okay? The raw materials is being credited for the actual quantity at the standard price. Okay. Okay, and the labor rate and efficiency variances go together.
You get 234, subtract that 240 minus the 6,000?
To get which one?
234?
This number?
Yeah.
The raw materials that is going to be credited for the actual pounds times the standard cost. The actual pounds used in production times the standard cost. This is the standard quantity I should have used times the standard pounds. So if you just look when we did 3B, so if you look at 3B when we did that, and we said we're going to do AQ times SP minus Q times SP, right? This is the raw materials inventory credit, and this is the works in process debit. That's pretty much how it works. And then the difference is going to be that variance. Okay? You don't have a question? All right, for the last one, the labor rate and labor efficiency variances. You're going to debit works in process for your standards. The standard hours times the standard rate. Okay. You're going to credit salary and wages payable for the actual. Okay. Now it's 39,424. This is labor. This is labor rate and labor efficiency. Okay? And we look back to C and D, both of those were favorable. Both our labor rate and our labor efficiency were favorable. So those will both be credited. Labor rate variance. And your labor efficiency variance. Okay? And those were for okay. 44,880. That is your standard hours times your standard rate. You get your standard hours by saying 8,800 units times 0.3 hours per unit. That gets you 2640. You do 2640 times the $17 per hour, and you'll get that 44,880. Okay. Any other questions on 3? Is everybody in Bentley's class? Yes? No? Nobody's in Bentley's class? Okay. Is she the one who cares about the journal entries, or is it your teacher?
Are you
Arlene? Okay. So you'll know when they're favorable, your variances will be credited, and when they're unfavorable, they'll be debited. So that's one way you want to make sure you can keep in mind about doing those journal entries. Every time they're favorable, it's a credit. Every time they're unfavorable, it's going to be a debit. Okay? So now we're on number 4. Dillon Corporation. Okay. So the Dillon Corporation makes and sells a single product. Overhead costs are applied on the basis of standard direct labor hours. Calculate the variable overhead rate variance, overhead efficiency variance, fixed manufacturing overhead budget variance, and the overhead volume variance. Okay. Everybody have the journal entries down? All right. All right. All right. Variable overhead rate variance. Okay. So we are doing the variable overhead rate variance, right? So once again, usually this amount right here is given to us as a total. And that's what it was given to us this time. AH times AR minus actual hours times standard rate. AH times AR, if we look over here, variable overhead costs, the actual is 140,500. Okay? Okay. How do we get our standard rate? How do we get our standard rate? Divide what?
33,900 divided by 5.
Divide what?
Or
What are we dividing?
oh, never mind.
How do we come up with a standard rate? Budgeted cost over budgeted units, budgeted over budgeted, what do they call it? Denominator, yeah, I don't even know, denominator activity level. Is that right? Everybody heard that word, denominator activity level, a million times? Why did I erase units and put that instead? Because it tells us our overhead costs are applied on the basis of direct labor hours. So my standard rate is my budgeted cost. My budgeted cost of variable overhead is what we're looking at. 123,200 divided by what? What is my budgeted denominator activity level? Budgeted denominator activity level. Are we looking at the budgeted column first? Just budgeted. Just this one. What is my activity driver, people? Thank you. Everybody understand what they just said? Everybody understand what my activity driver is?
What is it again?
Direct labor hours. Does everybody read where it says that? Overhead costs are applied on the basis of standard direct labor hours. That means I have to take that overhead cost and divide it by those hours. Okay? It can be on direct labor hours. It can be on units produced. It can be on anything that they decide to tell you for the test. You come out with that and you get a standard rate of 0.80. Okay? So we now have our actual hours is how many? What's our actual hours? 161,800. Make sure you use that same denominator activity. Times our standard rate of 80 cents. And that gives us okay, will this be favorable or unfavorable? Unfavorable. Our actual came out to be more than our expected. Okay. For B, I'm doing overhead efficiency variance, variable. Okay? Standard hours. All right? So we have to come out with our standard hours. How do we get our standard hours? Standard hours for the given output activity level. What is the given output activity? No. It's the standard hours for given output. What is our output? What do you produce? Okay, how many? 33,900. Okay, 33,900 times 5 direct labor hours per unit. And that gives us how many hours? $169,500. Yep. Okay. Is everybody following along how we got this? With these standard hours that you have to calculate, it has to be based on your given output. Okay? So you have a given output, that's the actual number you produced. 33,900, and you're going to make that times multiply that times your standard direct labor per unit. What's happening? What do you mean, like so many things going on? All right. All right. It is a lot. What you have to make sure to remember kind of are, it's going to be basically two kinds, a rate and efficiency. That efficiency, whether it's variable efficiency, whether it's your labor efficiency, or it's your materials quantity or efficiency, it's all about getting a standard hours for your given output. So that standard hours that you get there is always, I have to take the number of units I actually produced times what they told me was my standard, per unit. My standard rate per unit. It tells you in the reading. Yeah, half of this is reading it. You have to make sure you read that full problem. So I say, okay, I know it's $5 per, okay? So then I know to take that 33.9 that I came out with times 5 to come out with that hours for my standard hours. And then it's just doing the multiplication. Okay? And you get the standard rate the same way. It's still the same 80 cents. Okay? So now we're just doing actual hours times the standard rate. So the actual hours is the 161,800. And we can even make this into this one, right? What happened? Doing it this way or the other?
Yeah. Because then when you do the journal entries,
the numbers don't match up to what
you know what I'm saying?
to the math that was done?
Yeah. That's where, like, the numbers, I don't know what the numbers were. But when we were doing the other one.
Oh, for this one? For 3A and 3B?
The journal entries.
Oh, okay.
Yeah.
Okay. Okay. We'll go back and we'll clear that up then. All right. So then we won't do this. Actual hours times standard rate. Actual hours is 161. Standard rate is 0.8 minus the 169,500 times 0.80. Okay? Math. I don't have the answers this way. I got the answers one way, they give it to me one way, I can give it to you that way. So
So the first is 129,440.
129,440 minus
135,600.
135,600. Okay. The difference there is
6160.
6160. Okay. For C, calculate the fixed manufacturing overhead budget variance. The overhead budget variance is the difference between the actual and the budgeted. Okay? Okay. So the volume variance. The volume variance is the difference between your budgeted and the fixed overhead applied to works in process. Okay. To get the fixed overhead applied to works in process, you have to calculate the fixed overhead rate. Okay? First, you want to find your overhead rate. Okay? We tell its fixed overhead is 77,000 divided by what we thought was 154,000 hours. Okay? So we get 77,000 divided by 154,000 hours. Okay? And that's 50 cents per hour. Okay? Then number 2. You want to find the number of hours that we would be allowed. So what is our standard hours allowed for the given level of output? 169,500. We already calculated it. Okay? You'll be doing the same thing. We actually made 33,900. Each one gets 5 direct labor hours, so 33,900 times 5. All right? And then you just multiply that and that That gives you the amount of fixed overhead applied to your works in process. So we have 50 cents per hour as our rate times 169,500 as our standard hours. And that gives us $84,750 as our fixed overhead applied to works in process. So our volume variance is going to be our budgeted minus the fixed overhead applied. So this is going to be 77,000 minus 84,750. And this is 7,750 favorable. Okay?
Unfavorable.
You say?
Favorable why? Which is better or less?
Favorable, yes, because your budget is less. Fixed overhead, the fixed volume variance is the only one that's the opposite of every other one.
Okay.
It's the one that's the opposite. Okay? And it has to do with the amount that gets applied based on the hours. So it's like just because you have more hours, that's why it's favorable. That's the logic behind it. Okay? Now, last thing. Calculate the over or under applied overhead for March. Okay? So what we have is we have 11,060 unfavorable, 6,000 favorable, 3,000 unfavorable. 7,750 favorable, right? So, just gonna do 4E right here. All right, calculate the over or under applied. So far we have favorables or unfavorable 11,000 and 3,000. So 11,060 and then 3,000, right? And I have 6160 favorable. So this is unfavorable. This is favorable. You're basically just summing them up. Okay. Okay, unfavorable is greater, so I'll do that. Minus 13. I think that's it, 150. This is 150 unfavorable. So 150 of unfavorable means all right. Everybody got 4? Yes? You want to go back to 3 so I can show you those?
No, I get it.
You got it? Five and 6 are just return on investment, residual income calculations. Okay. Number 5, calculate the return on investment. Number 6, calculate the residual income. I think they want you to use the there's nothing really here to do. Return on investment. What's return on investment?
Net operating income divided by average operating assets.
All right. Oh, you got it. Net operating income divided by your average operating assets. Okay. It gives you numbers right here. 30,000. Just straightforward. 30,000 divided by 250,000. Okay. This comes out to be 0.12, which turns out to be 12%. Okay. Number 6. Residual income. It's your net operating income minus minimum required rate of return. Okay? Yo, do they tell us our net operating income? It does not. So in order to calculate our net operating income, we have to say what?
Sales times margin.
Same. Yeah. Yep. So they've given us that margin equals net operating income over sales. Right? So if I want to get my net operating income, then my net operating income is just your margin times your sales. So our margin is 10%. Our sales are 100,000. So our net operating income is 10,000. So net operating income 10,000 minus average operating assets 40,000 times minimum required rate of return is what, 18%? 0.18. So this is 10,000 minus okay. I passed around the roll. Can you please make sure you sign it and pass it back?
The lady who sets up the camera. Is she coming back?
I'll give it to her.
She said she would be back by the end of the session. I don't want to tell you.
All right, thank you.
Actually, I'm not going to do
Hmm.
Question. Don't be late, so I wasn't able to see you doing something just like